don't see any tax credits on your tax return and you are paying employee benefits out, then there might be an area where you can go and recover some of that tax back. Hey, welcome back to Profitable Preschool, the podcast that helps high-achieving childcare center owners like you scale smart, lead boldly, and manage every part of your business with confidence. I'm your host, Alexis Louis, and today we're going to be digging into a topic that causes way too many sleepless nights: taxes. But here's the truth. Taxes don't have to be terrifying. In fact, with a few strategic habits, you can make tax season feel like just another Tuesday. Let's talk about how to stay ahead of your taxes all year long so you're not scrambling in April or leaving money on the table. Let's be real, taxes can feel overwhelming. The rules change, the paperwork is endless, and the consequences for getting it wrong are not fun. But fear usually comes from one thing: not knowing what's going on. Just like running your center, when there's structure, support, and a system in place, even the chaos feels manageable. It's the same for taxes. Once you understand what's expected and build in the right routines, the stress fades. I promise. Here's how the most successful center owners stay ahead of the tax game. They treat taxes like they do any other important part of business, with consistency and intention. Here are the 3 habits that you need to adopt now if you want tax season to feel like a breeze later. And I know tax season just ended, but this is the time to start thinking about it. The first thing is to make your monthly bookkeeping a non-negotiable. No more shoe boxes full of receipts. Whether you use QuickBooks Zero or a great bookkeeper, your books should be up to date every single month. Make it a part of your routine, like payroll and staff meetings. The second thing you'll want to make sure that you do is meet with your accountant at least quarterly. Once a year isn't enough. Tax planning is a year-long sport. If you set up quarterly check-ins to review your numbers, plan for tax payments, and adjust any big changes like hiring or renovations, you'll be on the path to making sure that your taxes aren't terrifying. The third habit that you want to adopt now is keeping your business and your personal finances separately. I have worked with center owners who are making $1 to $2 million gross per year and are still using the business's checking account or debit card or credit card to swipe when they forgot their own, or because that was just the easier thing to do, or because they weren't paying themselves well and needed the extra to take care of things. You want to avoid doing that. Instead, you want to keep the business and personal finances separate. If you're needing money from the business on a regular basis, that means that you probably need to pay yourself more. If you need extra on top of whatever your salary is, you want to make sure that you are giving yourself a premium profit payout. And what that means is that each quarter, remember, you're making sure you take care of your monthly bookkeeping, you're meeting with your accountants quarterly. When you have that quarterly meeting with them, find out how much your business can afford to pay out to you based off that premium profit. You are giving yourself a bonus for the success that you have driven in your business this quarter. Because if you're still swiping one card for everything, business and personal, stop. Open a dedicated business account or make sure that you get a new personal account and make sure that you use it exclusively for what it's meant to be used for. It'll save you stress, it'll protect your deductions, and it'll also keep the IRS happy. Let's talk about saving money, because who doesn't love that? There are some common deductions that childcare center owners miss. The first one is staff wages and benefits. You pay salaries, some of y'all have health insurance benefits, and all of these are 100% tax deductible. Here's what I often see. One of the things that we do at Little Ledgers is that when we talk with someone, we first start with reviewing the last 3 years of tax returns. You've taken the leap of faith to make sure that your team has benefits. They have health insurance. They have 401k or simple IRAs. But what I've seen is that whoever you paid to do your taxes, whether you did them yourself, you hired a CPA who's not familiar with childcare, or you hired a childcare CPA who just isn't very familiar with taxes, and they miss deductions, not just deductions, more so specifically credits. If you don't see any tax credits on your tax return and you are paying employee benefits out, then there might be an area where you can go and recover some of that tax back. The second common deductions that child care center owners miss is facility costs. Obviously, you're paying the rent, but you also pay for repairs, utilities. Whether you lease or whether you own, these add up fast and they're all fully deductible. So you'll want to make sure that you're including those costs as well. And then if you're making major improvements, you're moving walls, you're redoing flooring, you're repairing roofs, portions of that are also deductible now. The third area where child care center owners often miss tax deductions is in educational materials and supplies. We're talking crayons and nap mats and software and even the fancy laminator machine that you finally bought. It's all a write-off if it supports your center. And you want to make sure that you're keeping all of those things, again, in that business bank account so that you're able to write them off at the end of the year. The fourth thing that's often missed in tax deductions are things for professional development. So whether you're subscribed to something like the Child Care Success Academy or Grow Your Center or any of the other things that are available out there, that staff training, those conferences, the coaching, it's not just smart leadership, it's a deduction. The fifth area that is often missed for tax deductions is meals and snacks. When you feed the kids, keep those records. You'll likely be able to deduct those costs, especially if you participate in the food program. And also keep in mind what you're doing for staff meals as well. And like I said, don't forget about tax credits. For example, if you're hiring people who generally would qualify for government assistance, there are tax credits specifically because you hired from that group of people. Those tax credits allow your center to keep more of its hard-earned money. Even the best center owners can make mistakes. Here's 3 that I want to make sure that you avoid when it comes to taxes because they are costly. The first one is skipping out on your estimated tax payments. If your business is profitable, and I hope it is, you'll owe taxes quarterly, not just once a year in April. Set reminders and don't miss those deadlines, or you're going to pay penalties. Here's the deadlines, just so you can add them to your calendar. April 15th, June 15th, September 15th, and January 15th. Those are the 4 dates that you'll need to make estimated payments. One thing I often notice when working with child care center owners, especially when they first come on with us, is that they're not really aware of the penalties that they've already paid for not making estimated tax payments. I talked with one center owner earlier this year, and she was unaware that for the last 3 years, she had paid tax penalties for not filing quarterly estimated payments. Her accountant never brought it up. It was just part of her tax return that was included as a conversation as this is how much tax you owe. With situations like that, it doesn't allow you to make improvements. Instead, you want to make sure that you're making those quarterly payments. The next mistake that I see is that some center owners are not reporting cash payments. If you accept cash, it still counts as income. And if you're paying out cash, those expenses also matter. So make sure that you're logging it properly in your bookkeeping system. The last mistake that I often see that's very costly is trying to do it yourself without expert help. As your center grows, your taxes become more complex. Working with a CPA who knows childcare, you'll save more money and sleep better at night. All right, let's wrap it up with a simple checklist that'll keep your center financially ready all year long. First, you're going to set up a recurring monthly money meeting. The second thing you're going to do is schedule quarterly reviews with your CPA and make sure during those quarterly reviews, you're knowing how much you should pay out in estimated taxes, if any. The third thing is to separate your business and personal finances. Don't use the business credit or debit card when you're going to get your iced coffee in the morning. The fourth thing is to digitize your receipts and organize them. This will make it so that you're not having to keep track of paper and so that nothing gets lost. The fifth thing is to make sure that you're recording all of your income and expenses, including things that you pay for or that you receive in cash. And the last thing is to keep an eye on new tax credits and updates. You'll receive them here, but make sure that your CPA is also aware. Remember, tax planning isn't just about complying with what the government needs. It's about maximizing what you keep and using that money to grow your vision. Remember, taxes don't have to be terrifying. They just need a system and a strategy. And now you've got both. If this episode gave you a little peace of mind or a new to-do list or both, be sure to follow, give a review, and share it with another childcare leader who deserves to feel confident about their finances. Thanks for tuning in to Profitable Preschool. I'm Alexis Louis, and I'll catch you in the next episode. Until then, keep leading with heart and keep your books tight.